again. Remember, the borrower has to receive these documents within 3 days. They can mail them to them. If the lender turns down the loan, and that's what I said earlier, these documents aren't required. So only if the borrower gets approved are these documents required. That now here's the key funny thing: RESPA, the Real Estate Settlement Procedure Act, doesn't have any penalty guidelines for failure to meet these requirements. Get that? So if they fail to do it under federal law, which they have to do it under federal law, if they fail to do it, there's no penalties. There's none delineated anywhere. There's no rule that says if you fail to do this, you owe $100 or you have to give them a free credit report. So I don't know. There's no teeth in this bite as far as I'm concerned. So I just wanted to touch on that real quick. That 3 days, but there's no penalties. There's no penalties written down anywhere as to what happens if they fail to meet that. Okay, so let's talk a little bit about RESPA and what loans and what's covered under RESPA. Okay, basically RESPA covers any federally related mortgage loans, right? Now, Mary and Alicia, you guys are real estate agents, so this applies to you in another realm as well, because we have RESPA rules about the kickbacks and stuff like that. Now, as with title guys, you guys are going to start getting into this a lot. So most residential loans end up being federally. I can never say that word. Maybe I should say government related, federally related loans in some way through some federal guarantee. So RESPA ends up covering like 90% of all the real estate transactions. All right. So Freddie Mac, Fannie Mae, Bernie Mac, Chili Mac, Big Mac, all those other guys that go in there. So there are some things that they call triggers. Now that was a joke. All right. Zeke's like, who? I'm writing those down. No, dude. Joke. Those last couple were humorous. Obviously not. Okay, so primarily Fannie Mae, Freddie Mac. Okay, is that good for you, Zeke? There you go. So you get a Freddie Mac, a comedian, no longer Chili Mac, Big Mac. Yeah, never mind. Too early in the morning. There are triggers that activate RESPA. Most loans secured by a first lien. All right, on residential property. Once again, residential property, not commercial property. First lien or subordinate, like a second, on residential property. Home purchases. Obviously, a home purchase loan is an acquisition loan. Lender approved assumptions. Now, you guys know what an assumption is, right? An assumption, I don't know if there's any residential loans out there that are assumable, and I'm sure that over the course of this online course, somebody's going to hear this and go, well, yeah, now there are. Well, there may be. They may come back. FHA used to have a freely assumable loan. They're going to expire at the end of 2016 because at the end of 86, it was 30 years, so they're all gone. I don't know any residential loans that are assumable. Assumable means that the lender has approved it. So an example would be like, Cindy's got a house. I want to buy Cindy's house, but I'm just going to assume the loan that she has, right? So I'm not going to come in. I'm not going to go get another credit and do all that. We'd call the lender and they would say, take Cindy's name off, add Raymond's name on. Now, lender approved in today's world means I would have to qualify just like getting a new loan. So it's not hard to get. It's not that they don't assume them. It's not hard to assume. I don't even know how to tell you what I want to say. The requirements of assumption aren't hard because it would be the same requirements currently to get a new loan. Banks don't typically let people assume because they probably, especially right now, may have had lower interest rates last year than they have this year. So the lender wants to, loan money out at today's rate, not yesterday's rate. So if you find a lender approved assumption, not saying that there's not out there, I don't know of any right now. RESPA would still apply to that. So when you do the assumption and change the names, all of these things would be required. Okay. A refinance. RESPA applies to refinancing. Loans for home improvements like a HELOC or a second mortgage. Anytime that you're dealing with that credit and that loan is going to go federally backed or anything like that, or federally guaranteed, you're going to pull in RESPA. HELOC, which stands for the Home Equity Line of Credit, it would also be a RESPA issue. And then the new thing is the reverse mortgage. The reverse mortgage, which we're not going to get into today, I think the reverse mortgages, if they are done the way they were intended, are actually a pretty good deal. All right, you know, but there's a lot of people out there that are perverting them for nefarious uses to cause problems or steal money or something like that. But I think that for what they are designed to do or were thought to do, they're actually a pretty good thing. So another thing that RESPA would be involved with would be the land contract. All right. If there's a sales contract or a sale for deed, and a land contract would be covered if the seller's taking back part of the loan and the other part is funded by an entity that would be covered under RESPA, then the contract would be covered under RESPA. Okay. Now let's back up for a minute. Does everybody understand either what a seller carryback or a land contract? Seller carryback is a short-term loan made by the seller at the table to the buyer to bridge the gap between the sales price and what the guy has. So let me give you an example. Sell for 100 grand. If I get an 80% loan to value, quick, 80% loan to value, what's that mean? Bob, $80,000 loan, right? And I've got 10,000 in cash, that's $90,000. The house was supposed to sell for 100. The seller can actually take back what's called a carryback for 10 grand. It works like a second insofar as it's an actual loan. We record a second lien, we call it a carryback, and I pay it to Bob. So every month when I write my mortgage payment for the $80,000 to Fifth Third, I would then write Bob a check for the $10,000 that I borrowed for the carryback. Now, because the $80,000 is RESPA required, that makes Bob's carryback also RESPA required. Okay. If they are not RESPA required, like on a commercial property, then the carryback is not also required to be RESPA compliant. So it is only if the first one is, and it's not if the first loan is not. Okay, cool. So what does RESPA not cover? Loans not covered by RESPA are specifically what they call exempt loans. May be good to practice to disclose all of those and the affiliated arrangements, but it's not regulated by RESPA to do so. Okay. Now, there's a word in there that we haven't talked about yet, actually, a series of words called the affiliated business arrangement. All right. The affiliated business arrangement. What an affiliated business arrangement is when a person, like, okay, here's a good example. Mary and Alicia, you guys are licensed real estate agents. You're also going to be licensed title reps. Now, I don't know if you're planning on practicing in both fields or not. I'm not saying it's good. I'm not saying it's bad. But let's say for the assumption of this conversation, you are going to be a modeling group agent, but you're going to go work for ABC Title as well. So you get a client and you say, I'll be your buyer. I'm going to be the selling agent, i.e. work with the buyer. And then when we want to write the purchase agreement, we're going to ask to pull the title from my company. So you would get the sales rep pay for taking them to the title company. Do you guys potentially see a conflict there? Yeah, exactly. That's why this affiliated business arrangement form or rule exists. Basically, what it says is if a person is going to touch a client in multiple ways, then they have to disclose that. Don't look at me like that. Don't laugh. Maybe what I should have said, if a business is going to make money off of that person in multiple ways, they have to disclose that to the client in advance, and it has to be approved, and they can say no, obviously. So, Alicia, if we said, okay, you're going to be their agent, and you said, okay, before we do this, I want you to know that I'm going to be your agent with the Modular Group, but I also am going to be a sales rep for ABC Title. So when we pull title, I'm going to get paid as a realtor from Raymond, and I'm going to get paid as a sales rep. Is that okay with you? That would be the affiliated business arrangement. Now, that would all be in writing, all right? Not saying it. It's got to be in writing. So, um, yeah, exactly, Alicia. That's exactly. You have to give them the chance to say no. For those of you at home, Alicia asked if that was a chance for them to say no. Yes, that's exactly what it's designed to do. Now, I used to own a home warranty company years ago, and we dealt with the ABA, and it was a form that said, "Hey, I'm a broker and I have a ownership interest in this company. If you use this company, I just want to let you know that I'm going to be making a commission here and something over there. And if you own like where you don't even have to be participate in the company. If you own part of the company, that's a problem. So you just have to disclose it. That's all that RESPA says. They don't say it's illegal. They just want you to disclose the fact that you have an affiliated business that you could be potentially making money on. Okay. Are we good? So that's what an affiliated business arrangement is. Now back to what we were talking about. Things that are not regulated by RESPA, which are called exempt loans, commercial loans. Commercial loans we've touched on. Business loans. I mean, if you're going to go out and buy a business, vacant land. All right, vacant land. Specifically, large tracts of vacant land. You're going to go out and buy 80 acres of farmland. Is not covered by RESPA. Construction loans, not the perm loan. The perm loan or the permanent loan would be because it's an acquisition of a house, but a construction to build the house. So the construction loan in and of itself does not follow RESPA's rules, only the permanent portion of the loan. Now, I don't know for 100% fact, but now most lenders do this thing called a construction to perm where it's one loan and it automatically switches. That's probably going to be covered because the construction is tied into the permanent loan. Used to be you could get a construction loan from Fifth Third and get the permanent loan from your local bank, and one would close and pay the other one off. In that scenario, the construction loan would not be there. Certain loan assumptions, and I think it's kind of funny here that certain means non approved. All right. So if you're not calling the bank to get that assumption, obviously governments aren't, so if HUD is buying a home or are getting rid of it, or actually government agencies as well as, I don't think banks are. So like REO properties aren't as well. All right. Any questions about what's covered and what's not covered? David? Yeah. Uh huh. Well, yeah. Okay. For you at home, he was saying the second loan. Yeah. A second loan would, so if you're getting what they call a piggyback, so I'm getting a first and a second, RESPA would apply to both of those as long as it's a 1 to 4 family residential home. All right. Which is like a single family home, which is probably 80% of what you guys are going to deal with. then yes, a first lien would be covered by RESPA, and a second lien would be covered by RESPA as well. Okay? Are we good there? All right. I think that does it for this section.